Okay, it says you should assume that today's date is 1st September 2023. Okay, we assume that, no issue at all. Liber has requested advice on the timing of the sale of the shares which he acquired in a recent company takeover. His sister Vista requires advice on the tax consequences of making lifetime gift rather than leaving an asset in her estate upon her death. Okay. Liber is UK resident and domicile. We know that whoever is UK resident as well as domicile, that person will have to pay tax on his or her worldwide income. Has taxable income 30,000 each year. Now listen, if someone is having a taxable income of 30,000 each year, it means basic rate band 7,700 is still left. Because the basic rate band is 37,700, if I minus the 30,000 taxable amount means after deducting the personal allowance. So still there's a basic rate band 7,700, because when it comes to calculating capital gain tax, we know that when there's a space available in basic rate band, applicable tax rate is 10%, otherwise it is 20. So this 30,000 means you still have a little bit of space in the basic rate band. Liber acquisition of ordinary shares in Mercury PLC. Liber acquisition of ordinary shares in Mercury PLC. Liber purchased 800 ordinary shares, 40% holding, that's quite sufficient holding, in Volcan Limited for 14,000 on July 2013. Now listen, Liber purchased 800 ordinary shares, 40% holding in Volcan Limited for 14,000 pound, that's a cost, in July 2023. Now you should be thinking for better. You should be thinking for the better, either it will be available or not, because one, the Liber has holding more than, let's say he's having at least more than 5% holding, and now we need to see the 2 years ownership period. Third, which we need to know if the Liber is director or employee of the, let's say, Volcan Limited. In that case, better will be available. Repeat, when the better will be available, simply when this Volcan Limited is a personal trading company for Liber, then better will be available. So we need to check for the better. We need to check for the better. Obviously the holding condition is met, ownership condition is met. Now we just need to know one more thing, that is either Liber is director or employee of this organization or not. Mercury PLC acquired 100% ordinary shares of capital of Volcan Limited on June 2023. So Mercury is acquiring obviously more than 25% holding. In exchange for each ordinary shares in Volcan Limited, Liber received the following: 4 ordinary shares in Mercury at a value of 20 per share immediately. After the takeover, there's a cash of 15 also. Very important point. Actually, Liber is getting 4 shares in Mercury against each share in Volcan. So number of shares, if I tell you, it is 800 multiplied by 4. So number of shares which Liber will be getting in this organization, there will be 3,200 number of shares. If I talk about the market value of these shares multiplied by 20, it becomes 64,000. So market value of the shares which Liber is getting, it is 64,000. When it comes to cash, 800 into 15, that is 12,000. It's a really good amount of cash. So due to this 12,000 cash, there will be a part disposal. So 64,000 plus 12, it gives me 76,000. The cost is 14,000. We need to allocate the cost of this 14,000. So 14,000 divided by 76 multiplied by 64. So let me check what is coming. 14 divided by 76 multiplied by 64,000. I'm getting 11,789. If I deduct 11,789 from 14,000, 14 minus 11,789. So the cost which is allocated to cash is 2,211. Obviously, due to this cash, there is a part disposal. If I talk about chargeable gain on cash, chargeable gain on cash, I'm not properly solving it, just giving you the idea. 12,000 minus 2,211. So the chargeable gain on cash is 9789. Okay. Look at this. Mercury PLC 200,000 issued ordinary shares. Now listen and listen carefully. Liber got 3,200 shares in Mercury, and Mercury has 2 lakh shares. It means when Liber will be selling Mercury shares, Liber will not be able to get any better. Why? Because the holding in Mercury is far more less than 5%. 3,200 divided by 200,000, the holding is far more less than 5%. So Liber will not be able to get better in Mercury because the holding condition is not satisfied. Liber has never been a director or employee of either Volcan Limited or Mercury. Now the job is done. In fact, the cash consideration which has resulted in a gain, even that cash consideration is not qualifying for better. No better is available. Why? Because Liber was not the director or employee of Volcan Limited. Since he was not the director, even though the holding was more than 5%, the ownership period is more than 2 years, but since Liber was not the employee or director of Volcan Limited, that is why a better is not available against the gain which is the gain which has come on cash consideration. And when it comes to selling the Mercury shares, the disposal of Mercury shares will also not qualify for better because one, the holding is less than 5%. Another problem is Liber is not the employee or director of Mercury. So simply Volcan Limited as well as Mercury both are not the personal trading company for Liber. Okay. The takeover was for a bona fide commercial reason and not for avoidance of tax. So that is why share for share relief is available, and the share for share relief says no gain or loss will arise against the share consideration which Liber has received, because it is a bona fide commercial transaction, a bona fide commercial takeover, and more than 25% holding Mercury has taken in Volcan Limited. Okay. Liber proposed transaction in Mercury PLC. Liber now wishes to sell all of his shares in Mercury PLC. He has received an offer from an unconnected person to purchase these shares on January that falls in the tax year 23-24 at a price of 28. Now listen. Shares in the Mercury. He has received 3,200 shares in Mercury. So the sale proceed 3,200 into 28. The sale proceed in Mercury. Let me use a calculator. 3,200 into 28. I'm getting 89,600. Cost I'll take from here 11,789. 11,789. That is, I'm just giving you the idea. I'm not solving it properly. The chargeable gain is coming 77,811. So actually, the chargeable gain on cash as well as disposal of shares in Mercury both are arising in the tax year 23-24. So the total chargeable gain, if I tell you, it will be 9789 plus 77811. 9789. I'm getting 87,600. Annual exempt amount is 12,300. Here comes the taxable gain. That is 75,300. Very important point. Now let's calculate CGT. CGT payable. Actually, in the basic rate band 37,700, there's a taxable income of 30,000, which means the available basic rate band is only 7,700 into 10%. I'm getting 770. If we deduct 7,700 from 75,300, let's see how much I'm getting. I'm getting 67,600. The applicable tax rate is now 20%. 13,520. Now listen, if the disposal in the Mercury, If I talk about part B, so first you need to explain the examiner. Number one, you will be explaining that disposal of Mercury PLC shares will arise in the tax year 24-25, and the capital gain will be same. And another thing which you need to explain, that the entire gain on cash, the entire chargeable gain on cash will be covered by the annual exempt amount. It means the tax will be safe, and another benefit is there will be a delay of CGT payable by 1 year. There will be a delay of CGT payable by 1 year. Now if I show you a little bit calculation, where it is here, part B. Part B of the question, I'm just showing you the calculation part. Theory part I have just explained you. Chargeable gain on cash. Chargeable gain on cash is actually arising in the tax year 23-24. The gain amount is, how much is the gain amount? 9789. It is 9789. It is covered in annual exempt amount. So 24-25 capital chargeable gain on Mercury shares. Chargeable gain on disposal of shares in Mercury. What is the amount of the chargeable gain? It is 77,811. Let us deduct the annual exempt amount, which is 12,300. Here comes the taxable gain. Here comes the taxable gain. 77,811 minus 12,300. 65,511. Now let's calculate CGT payable. Obviously in the basic rate band there is a space of 7,700. 37,700 minus the taxable income 30,000 into 10% will get 770. If we deduct 7,700 from 65,511, let's see how much we are getting. We are getting 57,811 into 20%. It is 11,562. So 12,332. So there's a CGT saving. CGT saving. Earlier the CGT was coming, CGT payable was coming 14,290. Now it is 12,332. So what is the amount of the saving? It is 1958, the amount of the saving. Now listen, you also need to mention the date. Due to delay in selling the Mercury shares, there will be a exactly 1 year delay of paying in CGT payable. Because if you sell Mercury shares in the tax year 23-24, then the CGT will be paid on 31st January 2025. Now obviously you will be paying CGT. One, you will be paying less CGT. Second, you will be paying CGT on 31st January 2026. Obviously by doing this you will be getting a commercial acumen marks as well, because while delaying you are getting benefits. So that is a commercial acumen. That's a commercial acumen. Means you are being wise. Okay. What I've done, I've already did the little bit drafting for you to save the time. Look at this. The share for share rules will apply because it was bona fide commercial reason. Mercury took over more than 25% holding in Volcan Limited. Therefore, no gain or loss will arise in respect of share consideration. The Mercury share will take on a proportion of the cost on the Volcan shares. See the table below. I did this on the spreadsheet. A part disposal calculation will be done and the gain will arise in respect of the cash consideration. See spreadsheet. I'll take you the spreadsheet, don't worry. Better will not be available in respect of the gain arising in cash consideration as Liber was not a director or employee of Volcan. Okay. If I show you the calculation, look at this. It is exactly the same calculation which we have done right now. Shares, market value. How did I calculate market value? Look at this. B2 multiplied by 20. Then the cost. The chargeable gain. How did I calculate this? You can see this. From this 12,000, I deducted the cost. From 12,000, I deducted this. Better is not available on gain arising on the cash consideration as Liber was not. You have to mention this why better is not available. If you're not mentioning, you'll be losing marks. Gain on the Mercury shares 89,000 minus this. Chargeable gain, again the gain on Mercury share is not qualifying for better. The same reason. The taxable gain is 75,300. This is total how I got this. You can see taxable gain. Then how did I get this? Look at this. Then simply 10%, 20% total. That is part B. Deduct the annual exempt amount. Look at this. So tax saving. So more or less we are getting the same values. Now if I go to part B of this question, advise Vesta whether or not there are any capital gains or IHT advantages of herself or John's if she were to gift investment property to John's on December 2023. December 2023 means the tax year is 23-24. Okay. Let's read the question. Vesta. Okay, Liber would prefer to sell shares to his nephew Johns. However, this would delay the sale and nephew will not have to necessary funds to purchase this until May 2024. Johns will pay this. Obviously, the delay was a better option. We have already decided. Vesta is 66 years old and has never married or had a civil partner. Very important one. Never married. So you should not be thinking for the marriage allowance. No marriage allowance. Why? If someone is not married, then obviously you should not be thinking for the marriage allowance. Number one. Number two, you should not be thinking. One, you should not be thinking for the marriage allowance. Second, you should not be thinking. One, the marriage allowance will not be available. Second, unused nil rate band rule cannot apply. Because unused nil rate band can only be applied when there's a married couple, one dies and does not uses the whole nil rate band, then obviously the transfer of nil rate band issue arises. But over here on IHT, no unused nil rate band issue will arise because Vesta never married and no marriage allowance issue arises. Okay. Is in ill health and is expected to die at some time within the tax year 24-25. Okay. Has made no disposal for capital gain tax purposes in the tax year 23-24 to date and will not make any disposal in the tax year 24-25. It means annual exempt amount will not be utilized. It means annual exempt amount will not be utilized. In other words, annual exempt amount is available in the tax year 23-24 and 24-25. Has made one previous lifetime gift of 3,50,000 cash now to her son John's on 1st June 2023. Now listen. They said never married. Now from where the son is? What is this? Okay, I don't want to say anything. It's a question because they said something. Okay, leave it. has made one previous lifetime gift of 3,50,000 cash. Okay, now listen. When it comes to CGT, cash is an exempt asset in CGT. Cash is an exempt asset in CGT. Okay. Second, when I talk about IST, giving gift to son is PAT. In the tax year, this date means 23-24. Against this 3,50,000 PAT, annual exempt amount 3,000 of the current year and let's say 3,000 of the previous year will be available. So the gross chargeable amount is 3,44,000. And if Vesta dies within 7 years of making the gift, then on this 3,44,000, death tax will arise. But obviously on the entire 344,000, death tax will not be paid. From this 3,44,000, nil rate band of 3,25,000 will be deducted. Whatever is left on that, 40% will be paid. But if Vesta dies after 3 years of making the gift, then what happens? Then IST payable on death will be reduced due to taper relief. But in order to get taper relief, donor needs to die at least after 3 years of making the gift. So now let me tell you one thing. When it comes to son, either this gift of cash is given at the time of, during the lifetime or at death, son should not be having any issue. Why? Now listen. The gift of cash is exempt under CGT. Second, if this cash is not given as gift during the lifetime, it is left in the death estate, then the CGT does not arises on the death estate. It means when it comes to CGT, when it comes to CGT, capital gain tax, when it comes to CGT, capital gain tax, when it comes to CGT capital gain tax, son should be indifferent. Son should be indifferent. Either the cash is given as gift during the lifetime or at death, because in both the cases, son is not paying the tax because it is exempt. Okay. Now let's talk about IST. When it comes to IST, during the lifetime, it is PAT. So in case of CGT, son must be indifferent. Either it is given 3,50,000 is given during the lifetime or at the time of death, because in both the cases no CGT will arise. Okay. Now let's talk about. Okay, now what? They're talking about. Now let's talk. Obviously, now if you go to investment property, actually they're asking for the investment property. Okay, if she were to give investment property to Johns on December 2023, okay. They're not talking about the cash, they're talking about the investment property. Let's see what is investment property. Vista owns an investment property which has never been used as her private residence. It means for CGT. Do not think for the private residence relief. Do not think for the private residence relief. Okay. The current market value of the property is less than the price Vista paid for it, and its value is expected to fall further throughout the tax year 24-25. Okay. Vesta is considering gifting the investment property to Johns in her lifetime rather than leaving it to him in her death estate. Johns is the sole beneficiary of Vesta. Now let's talk about this CGT of investment property. Now listen, what is happening if I talk about the CGT. Now listen, if investment property is left on the death estate, if investment property is left on the death estate, then no CGT arises. Repeat. If investment property is left on the death estate, then no CGT will arise. No CGT will arise. Okay. Another thing, if investment property is given as a gift on December 2023, which is the tax year, which falls in the tax year 23-24, then what happens? Then capital loss will arise. Why capital loss will arise? Let me explain. Capital loss will arise. Why? Because the market value of the investment property is lower than the original cost. The market value of investment property is lower than the cost. So capital loss will arise. But the point is, whatever the capital loss arises, Vista will not be able to utilize that capital loss because Vista is not going to sell, will not be selling any asset in the next year 24-25. So logically, even the Vista gives this investment property as gift to her son, it will result in a capital loss, but she will not be able to utilize the capital loss. She will not be able to utilize the capital loss because in the next year she is not selling anything. So it means that when it comes to Vista, Vista should be indifferent whether the gift of gift of the property, you can say, whether the gift of the property to Johns is given as gift during the lifetime or leave it on the death estate. But when it comes to Johns, it is mentioned in the question that the value of the property will further decline. When it comes to Johns, if this property is given as gift during the lifetime, the benefit for the Johns will be, the base cost for the Johns will be higher as compared to when this is left in the death estate. So there's a little benefit if Vista gives this property on gift on December 2023 because son will have a higher base cost. So there's a little benefit for the son. Okay, now let's talk about IST. Obviously, when the property is given as gift to son, during the lifetime it is PAT. It is PAT. Okay. And when the cash was given as gift? Cash was given as cash. Has made one previous lifetime with 350,000 to her son Johns on this date in the tax year 23-24. Now listen, investment property will be given as gift also on December 2023 and this date also fall in the same tax year, which means that when you are giving investment property when you are giving this investment property or property as gift, it is PAT. And against that PAT, annual exempt amount will not be available because that annual exempt amount is already utilized by the cash. Annual exempt amount is already utilized by the cash. So during the lifetime, there will be no IST, it's a PAT, but annual exempt amount on this property will not be available because cash has already utilized the annual exempt amount because the cash to Johns and the property to Johns both are falling in the same tax year. So when it comes to death tax, if the vestor dies within 7 years of making the gift, then definitely death tax will arise on this property. But since it is mentioned in the question, that the further property value will decline, then fall in value relief will be available. So on the death tax, fall in value relief will be available. Okay. If instead of giving the investment property during the lifetime, gift to Johns if Vesta leaves that property in her death estate. Then obviously at that time, whatever will be the value, it will be a reduced value as compared to today's value. That value will be taken in the death estate. Okay. And again, everything will be same on the death tax also on investment property when Vesta leaves in the death estate. So basically, if Vesta is dying within 3 years, if Vesta is dying within 3 years, then the death tax and the tax which will arise on death estate will be same. So in that case, Vesta as well as son both should be indifferent. But let us see when the Vesta is dying. Any expected date? Vesta is giving this. Vesta owns an investment property which has never been used. This Vesta is considering gift the investment property to Jones in her lifetime rather than leaving this. Okay, any expectation about the death? I just want to see. Is in health, is expected to die sometime. So just in the next year, there's a possibility that Vesta will die. So if Vesta is going to die just within 3 years, obviously, then either Vista is giving this property as gift during the lifetime or death estate. IHT will be same. IHT will be same. So son as well as Vista both should be indifferent when it comes to IHT and investment property. So dear student, I really appreciate if after exactly watching this lecture, if you go to the kit, I think from the kit it's maybe question 47 if I'm not wrong. From the Kaplan kit, I really appreciate if you go and read the answer at least once. And if you have still any queries, you can always ask the question in your respective WhatsApp groups. So thank you very much watching this lecture. Inshallah, very soon I'll be uploading the video lecture on test 6. Thanks a lot.